Hey everybody, Real Estate Ninja here. I hope you're doing well. Got a great story out of CNBC, and we've been covering this story for a while. It's very telling of where the economy is, where the home buyer is, and where we are in this cycle. But it's literally not until the very end of the story that really tells the key point, the most important thing. It's just almost like an update. The title of the story is Mortgage Demand Drops to the Lowest Level in 3 months. Now, we all know that that would make sense, right? Because mortgage rates are skyrocketing. We're seeing well over 7%. As a matter of fact, doing a quick Google search the other day, came up with 8% for a 30-year loan, 30-year fix. Now, we all know that we can get it for cheaper than that, but it is well above 7 now. And I've been saying or calling for mortgage rates to be in the 10%. Why? For a couple of reasons. Not only is the Fed raising their key benchmark rate, causing it to be more expensive for bankers to go and get the money to go and loan to you, right? And they have to make their profit, but also because of risk. Banks are not wanting to take on the added risk right now because they know at these elevated levels of mortgages, the rates, and the elevated levels of home prices, they're seeing too much risk that borrowers are not going to be able to pay. So let's dive into this real quick, and then I'll tell you this last sentence, which is the most important and most telling. Mortgage rates shot up higher last week as stronger economic data stoked more fear that the Federal Reserve will not lower interest rates anytime soon. In turn, mortgage demand dropped to the lowest level since the end of February. The average contract interest rate for 30-year fixed-rate mortgages with conforming loan balances, which equals $726,000 or less, increased to 6.91% from 6.69, with points rising from 0.83 from 0.66. These points, these fees keep going up. That's because banks are pricing in risk. They say if you want a loan, you are going to pay for it. Now it says right here, these are for loans with a 20% down payment. So when I was talking earlier about over 7%, I am literally referring to loans that are conforming, but the ones with 3%, 5% down that most Americans are actually putting down. Remember, this is the last part of that wave where you have literally the dumb money, the uneducated money, the people that have no concept of what's going on in the market. As it's cresting, they're buying homes out of emotion. Now it says right here, that was the weekly average according to Mortgage Bankers Association, but other daily reads saw the rate head over 7%, like I was telling you about. As a result, mortgage applications to refinance a home, which are most sensitive to rate changes. Why? Because you've already got a mortgage. So if all of a sudden you're going to apply for a mortgage refinance, it's because you really, really need the money. More than likely, it's for debt consolidation. Decreased by 7% from the previous week. Seasonally adjusted application volume was 45% lower than the same week 1 year ago. Now, let's talk about that again. Now, to think that refi rates are down only 7%, now think about this. This is very important for people to realize. That means there is a lot of people out there, essentially 93% of the refis out there, they're refinancing at higher rates. That means they are desperate. More than likely, they're not doing it so they can go take that money and flip another house. Not in this market. They are doing it for debt consolidation. I'm telling you, we are at that end phase. And that is a great sign for those of us that are waiting to buy homes, because we're going to be buying homes from the banks when they take them back from the people that were trying to do debt consolidation and could not hang on. It said applications for a mortgage to purchase homes dropped 3% for the week and were 31% lower since the same time a year ago. Application, and I want to explain something too, just because you'd think, well, 31% lower from last year still means we've got a lot of buyers in the market. That's not true, because this time last year is when home buyers started to wane. They started to just walk away from the market, and they said this was insane because rates had gone from a 3% to literally around 4 3/4 to 5% this time last year. This is when all buying really pretty much stopped. Velocity of transactions fell off a cliff in June of last year, okay? So those numbers last year that they're comparing them to now were really low, all right? So that's another thing for people to realize. Now, this is the most important part right here. It says the direction of mortgage rates depends mostly on new reads of the economy. The next one comes Friday with the release of the government's monthly employment report. Now, that is so true, because as we see more and more people get laid off, that's less money that goes in the economy. That means that's less stimulus as far as their dollars floating around in the economy to keep things bolstered up. Now, with that being said, I have not noticed a ton of massive layoffs in the last month and a half. I've talked about this quiet storm on the Economic Ninja channel when it comes to the bank crashes, the bank closures, and I said we're in that storm. So I believe you're going to get a pretty good employment report as far as there's not going to be a ton of layoffs showing. It'll go up, but it's not going to be massive. And so that right there will show the banks, you know what, the Fed is absolutely not done. They're going to keep raising rates. They have not completely broken the back of the economy. But the thing is what the truth is most employees are underemployed. They're not working full-time jobs or working a couple of jobs to make ends meet. So I think that you are going to see the long-term trend this year rates going higher still to fight inflation. I think that you're going to see volume of real estate transactions decrease significantly, but you're still going to see those mortgage rates up there and those points higher. So this is going to be a good sign for you to continue where you are, saving up and getting ready, getting out of debt to purchase these homes when they go on sale from the banks. Now, again, that's going to take some time. That's why I'm trying to prepare people as long as, as far ahead as possible, because these transitions take a long time. All right, guys, that being said, I thank you so much for watching. The Real Estate Ninja is out.